Hi, folks. Welcome to Code and Concrete, where we share the latest trends and the stories of trailblazers in the built environment. We hope you gain some insight from our wide range of topics such as real estate development and sustainability, or blockchain, artificial intelligence, and data. Joining us today is Grayson Frazier. Grayson is the vice president and was the first sales hire at Mogul, a real estate investment startup pioneering fractional ownership as the future of real estate investment. By lowering the barriers to entry, Mogul enables investors to own shares of institutionally vetted, high-performing properties without the burden of full ownership. He's been a real estate investor and blockchain enthusiast since 2018. He also wants you to know that he played college tennis, enjoys golf and the outdoors, and time with his young family. So this is interesting. I always like to dive into the background of people before we talk about the business side of things. And I'm glad you included the student athlete stuff because I think it is a really important part of people's personalities. So let's start there. What was school like? Did you go to college? Did you major in something? And how did you start to make that transition into real estate investing?
Yeah, totally. Well, first of all, thanks for having me on here. So yeah, I started, playing tennis when I was very young, 5, 6 years old. And, it really resonated for a few reasons. One, tennis, especially when you get to like the team aspect, it's like the perfect balance between like the solo and the team aspect because you're part of a team, but you're competing, traditionally in a singles match. So it's just you out there, so you have to, adapt on the fly. You need to be kind of mentally tough. And, as a young kid that just, fit right for me. I played a bunch of the team sports too, but, tennis just kind of led the pack. And then, from there, pursued it further, played in college. I had an interesting transition in college because, being an athlete, you get injured, you work with PTs and, sports, therapists. And I actually went down the path of exercise science and kinesiology to become a physical therapist. But, in the back of my mind, I was always really interested in Silicon Valley and startups. And actually halfway through college, I pivoted. And then right out of college, started working for startups and, never really looked back. But yeah, to answer your question on real estate investing, graduated 2015. All my buddies, move out of their parents' place, basically burn all their available cash on rent. And I didn't see it that way. I wanted to, eventually own my own place. And so I stayed at my parents' a couple of years longer, saved up, bought my first place at 24 years old here in LA, rented out some of the rooms. And then, from there, converted duplex, sold that, bought a few other income properties here in Southern California as well. So, that was kind of my journey from student athlete to real estate.
So did you or do you at any point use that college knowledge that you've accrued, or have you found that what your life is now and real estate and blockchain, it's all up to you to research this stuff, learn the latest trends, and try to apply it?
Mainly up to me. You realize most of the important knowledge that you use and pass on is post college. Again, it depends on your field, depends on your major, but I think in the business world, especially like startups, you learn, trial by fire. Learned most, if not everything, out of college when I, got into investing and real estate as well as startup.
Right. Yeah, that's pretty common for entrepreneurs. Now, you mentioned that you did work for a few startups. What were those startups?
Yeah. So the one right out of college, directly, I was there for about a year. It was a digital tablet food ordering company. So for example, at restaurants, instead of like paper menus where they have to reprint if they change the menu, it was digital. But the big one was for hotel rooms and room service. So, having the ability to have this little tablet right there with kind of food on the screensaver, these really nice photos of food making you hungry, just kind of, order, done, done, done. And it ended up increasing, a lot of the revenues for these establishments. So that was first, second, and the one I was at the longest, where funny enough, I was the other first sales hire, employee number 6. And when I left, we were like 150 employees. So learned a lot there. But that was a kind of home improvement financing company, but specifically in the energy efficient space. So we financed a lot of solar panels, other energy efficient upgrades to the home as well. So kind of tying in the finance, a bit of the real estate aspect there. Yeah, then fast forward to Mogul.
Well, let's go normal speed. How did you go from these startups to finding the Mogul team and becoming their first sales hire?
Yeah, so summer 2023, I, you know, scrolled LinkedIn and found their sales director kind of position. And it was interesting. It had been posted like 9 hours ago, and there was 307 applicants already.
Oh wow.
So, I mean, it resonated for me because I saw that they were combining two of my passions, blockchain and real estate. And just like the way it was worded, it was very clever and really, really just resonated. But instead of being one of 307 applicants, I actually just joined the platform as an investor. So explored kind of their first few properties, invested in them myself, kind of built a relationship with Alex and Joey, the founders from there. And when I felt there was enough repertoire, I just said, "Hey, I want to help you guys scale this thing," and it was kind of an easy in. So, yeah, I don't know any tips for people trying to apply to jobs. That helped me, a lot. Just kind of cut through, all those applicants. So instead of just being a number in a huge haystack, you can maybe join, show your value, feedback, and then from there, kind of throw your hat in the ring. So yeah, that was how I got started with Mogul.
That's really interesting that you were a user of the platform and could see the value in that, because then when you go and talk to other people, you can relay that value better, just highlighting the things that attracted you to invest and then reciprocating that towards other people. Although I should ask, are you on more of like the B2B, like attracting real estate developers supply side, or talking to investors and helping them write those big checks into deals?
More so the latter. So on the demand side. So, Joey is the other co-founder. He was part of the supply and research side at Goldman Sachs. He's brilliant with this stuff. He handles the supply side. The demand side is, the sales team. So, me, partly our CEO and some of the other sales guys. So yeah, driving investor demand, whether it's, on an individual or retail basis, or, be kind of strategic B2B kind of partnerships where it makes sense for them or their users to get access to, our kind of high quality inventory in a sense.
Sure, sure. So going from investing in real estate on your own to seeing this fractional blockchain-based model, what stood out to you and why did you decide that this could, maybe, and now seems to be the future of real estate investing?
Yeah. So again, I guess the initial spark for me was combining two of my passions, blockchain, real estate, and then kind of diving in to see what problems that solves, in kind of the industry. And I think with any good company, any good sales pitch, it doesn't have to be that complicated. It's simply just, what problems are you solving? How effective is your solution? So when I fully grasped that, fractional ownership, solves almost all the headaches of real estate investing. The immense time it takes to research, acquire, manage, and eventually sell your property. I mean, that's a lot of bandwidth taken. So fractional, it's 99% passive, with the 1% just being, log in, create a profile, and pick and choose your kind of properties you want to build out. So yeah, solving all those headaches. The big one though being affordability. I'm sure there's a question here about like trends, but back in the 1960s, 4 out of 5 roughly Americans could afford property today, or back then, and today it's sitting at 1 out of 5 Americans. When I was born in 1992, the average home value was $127,000. Today it's $430,000. So, you look at these trends, and when you realize that, you know, owning a piece of the asset on your own budget, on your own affordability terms is going to make a lot of sense now, will continue to make a lot of sense in the future because, we're 1 out of 5 now. In a decade, is it 1 out of 9 Americans? So the whole concept of owning, the asset fractionally as these trends, unfortunately, probably continue, to me was whoa, I want to establish myself here and help grow this thing, not over 1 or 2 years, but, a decade plus.
So Mogul is primarily focused on residential, correct?
Correct. Yeah. Single family rentals, which was Alex and Joey's kind of expertise at Goldman Sachs. But also gives us quite a lot of flexibility with, you can rent it out long term. You can do short term rentals like Airbnb, vacation rental models, but you can also, something we've really explored lately that's been doing really well is medium term rentals, workforce housing, traveling nurses. The average occupancy is like 9 months. So gives us a couple verticals to play with. So yeah, with single family rentals.
Do you have any regional preference?
We like the Sun Belt. We're fairly market agnostic. Some companies really hone in on like one market. And again, that, for us, part of the value add is you can diversify across many states,
Right,
many markets. As retail investors right now, like, I want to own an income property. You're putting a lot of your eggs in one basket. There's a lot of concentration risk. So instead of putting 200, K down on, an investment property, you can put 50K down on 4 across different states, different markets. Again, hedging your risk, diversifying from there. So we like Texas a lot. Houston and Dallas specifically have really strong fundamentals, landlord friendly. Atlanta, Georgia has been another kind of pocket of focus. But other than that, we own in Arizona, kind of East LA. We have a kind of an Airbnb out there. So yeah, those are the kind of areas we look at.
Now, comparing this digitized, fractionalized model to traditional syndication solutions, or I guess focusing on the blockchain portion, right? So when you start to implement blockchain, which is something that you've engaged for 7 years now. So you've seen the cycles, you've seen the ups and downs, different use cases emerging. What really stands out as a strength for that technology compared to traditional syndication or possibly fractional investment platforms that aren't using the technology?
Yeah. So the concept around syndication within real estate's been around for, many, many years. But the biggest gripe and headache with, operators in that space is the manual tracking of everyone coming in at different dollars amount, the documentation required. It's a lot of manual work. You literally have to hire a back office team just to do that. Whereas blockchain, being a digital immutable ledger in a sense, makes it automated, makes it transparent, kind of makes the back office extremely efficient. So from an operational perspective of a business, makes a ton of sense. It also just allows for easily kind of traceability of the ownership, because the way we're using it is basically through tokenization. And I'll describe a little bit of what that is. Every property is owned by an LLC. That LLC has shares in it. And we basically just digitize those shares so they can be brought online, kind of easily owned and invested in. And then from there, the direct ownership is, I guess, more applicable, because some of the other companies out there that do fractional, REITs, real estate investment trusts, for example, like, you're not a direct owner. So yes, you participate in, dividends and equity appreciation, but you're missing out on such a key piece of real estate investing, which is tax benefits, and then through kind of our direct ownership model, through the LLC, at the end of the year, depreciation, operating expenses, all this gets passed to the investors. So if you made a, 8% yield on your rent for the year, most of the tax benefits are going to offset most of that. So again, lowering your taxable income at the end of the year. So yeah, that's kind of how we use it, why we use it.
Well, I think the tax part is really important to highlight because if people wanted to invest in real estate now, generally they would have to go to the public markets where the REITs are lower price point, might have liquidity in case they need to bail on the investments, and they can do a little bit more research. Versus these private market deals, you have to know the right people, and then you might have to meet their check size. But that particular pleasure of receiving tax benefits and picking out the deals that you want and maximizing that as opposed to just putting your money into something that has a medium return. I think it's underappreciated, under highlighted in the real estate investment community. Let's just take a moment to kind of cover what a return or an investment could look like with and without applying those best best tax practices, essentially.
Yeah. Well, I can tell you right now, so the US REIT industry is like a $1.4 trillion industry, and 1.2% of that is captured through this one index that, basically did like what was it, about a 4.1%, return last year, pretty, on par with maybe inflation. So again, you maybe get security of throwing into, a public market that is massive, but your returns are going to be mediocre,
Right.
whereas the way we do it, it's more specialized, our due diligence process is extremely strict, again, Joey's kind of using his Goldman blueprint and even making it stricter because it's his own business. And, out of 1 out of 1,000 properties we vet, we maybe are going to move on one or two of those. So kind of a 0.1% acceptance rates, which we say is less than Harvard. But yeah, it's just more selective. It's, I kind of think of it as more like, SEAL Team 6, tip of the spear. And that's kind of why it returns through, our system and kind of the fractional model in general works better. But yeah, I mean, our portfolio IRR sits at, roughly 18 to 19%, which we're really proud of. Yeah, I'm sure there's a question here about our competitors, but yeah, I can either dive in that now or later. It's up to you.
Well, still on the tax side of things. So if you're targeting about 18% IRR, what does that look like if you're not leveraging tax codes? Like where does return get hampered for investors if they're not being strategic about how to make use of the depreciation or operating expenses?
Right. So like I mentioned in REITs, it's just kind of exposure to the rental dividend and equity appreciation, but there's no tax benefits in there. So yeah, I mean, like, on the topic of leverage, I mean, yeah, we finance these acquisitions. We're going to put anywhere between 25 and 35% down. So obviously, returns are levered as well. To us, we do it in a smart, effective way, but
Sure.
that's the best way to kind of grow a portfolio effectively and kind of spread the capital. Again, diversifying, get more assets kind of on platform from there. But yeah, hopefully that answers your question there.
Well, I think there's a lot of different ways to skin this cat when it comes to real estate investing. And I mean, right down to the due diligence itself, they always say the money's made when you buy. And so being able to underwrite these properties efficiently and choose the best of the best, and then that's what you bring onto the platform and guarantee the returns. Well, not quite guaranteed. Risk is always implied, but to assume those strong returns up front as opposed to having to, perform a particular renovation or something that adds a little bit more risk or opportunity for failure, just knowing that the underlying asset is good enough and that's the foundation for the return. I think that in and of itself is a good strategy. And then, of course, the different tax benefits that you can incorporate in there. And the overall returns, like we said, compared to what a REIT might offer, are substantially greater, like multiples greater annually, where it's not just about parking your money somewhere where it beats inflation, but it beats inflation to death, and you really get to see a return on your investment. Now, on the return side of things, what does your average deal length look like? And are you looking to leverage tokenization for potential liquidity to shorten that and let people exit faster?
Yeah. Great question. Really intuitive because yes, we are. So the typical hold period for our asset is going to be somewhere between 5 and 7 years. And, I kind of say this, the illiquidity of real estate is, one of its benefits. People overtrade assets all the time. I mean, just look at the stock market, whereas,
Mhm.
time in market versus timing market. I think Buffett said that. So 5 to 7 year hold, investors can certainly stay in until the asset sells at that time. But we are building this secondary kind of liquid exchange where investors can sell their shares in a property at fair market value. We're targeting that to be done in Q2 of 2026, so I don't know, a year and a half away or so. Um, so yeah, give them the out if they so want, but can certainly stay in and keep kind of punching their monthly rental coupon as they go.
Where do you see the challenges and opportunities in a marketplace for secondary trading? Because I've been in the industry for a while and I've seen a lot of pushback on the secondary markets. Oftentimes they struggle with execution, and there's platforms out there that discover that illiquidity persists even when you give people the option for liquidity. So how do you think you guys are going to navigate that? And what might the industry need in order for a more proactive market?
Yeah. So, pros and cons, benefits and challenges of a secondary exchange. The pro being simply that it's an option.
Mhm.
People feel wary about tying up, their money for many years. It's just a nature of us. It's trusting that third operator for half a decade.
Right.
So I think that's a big one for people, just knowing that it's there. Challenge, yeah, for me, it's humans are emotional creatures. So, bad headline on, the real estate market. I worry that, people will, rush to sell. Um, and then, that'll be absorbed. And I'm not in charge of the secondary exchange. That's Alex's kind of brainchild. And, he's certainly the one behind that. But to me personally, that would be the worry. But, you know, zoom out, if there's maybe short-term pain in whatever this year or in 3 years or 7 years, zoom out on any 7 to 10 year horizon in real estate. Real estate's never been down. We might have some down years, but over time, yeah, it's a non-issue.
Well, and if everyone does rush to sell, if they're going to exit, there has to be some sort of buyer on the other side. And this is where a lot of platforms that are often building in silos become trapped, or at least it appears that way. And so I think interoperability and just the presence of more active players on chain and then really good price discovery are going to be some solutions for that, because one person selling where they anticipate a crash could be another person's opportunity to buy in inexpensively and ride the next 18 months to another glorious return. So it just comes down to the the availability of data on those assets so that we can make informed decisions. And this goes back to your due diligence process. What do we know about this asset? What has it done historically? And what do we think it'll do in the future? And how can we try to minimize the gap between our expectations and the reality? And if we can do that really well, then no matter when people are buying or selling, they have that confidence in doing so, as opposed to that sheer emotional speculation and Hail Mary play.
Totally. And the way I see it is by the time we'll get to a secondary exchange that is up and running, people will have already built that confidence and trust in us and seen their portfolio grow, see the assets perform and say like, these are good. I don't need to punch out on some bad headline. I'm going to stay in this. And yeah, again, due diligence, like you said, that's kind of our That's the bread and butter. That's what differentiates us from the competition. It's really simply just the type of assets that we're bringing on platform. And not only type, but like number of, some of our competitors, and, I respect them so much for being first movers in this space, but they focused a lot on the novelty of the tech and wow, you can own a piece of property for $10 or $100, but not so much the underlying asset. And we kind of took this of let's focus more on the asset first, make sure it's a good thing, good investment, and kind of go from there. So again, instead of throwing 200 properties on our website and not knowing which ones to invest in, and some being, home runs and some not, we figured we'd rather kind of do more quality over quantity. I think some of the opposite.
And I think that's the right way to go. When you and I had met recently, that was what stood out to me, is that you are putting the emphasis on the real estate itself and not the technology. I always tell people you could tokenize anything, but they often equate it to putting lipstick on a pig, right? I even tell people you can tokenize a cow pie. And to me, this presents a blunt reality that the technology itself is a commodity. It's not super special. There's a lot of platforms out there, and what's going to create winners are those who call upon the traditional finance knowledge, good old real estate, and say, how do we make really good deals, and how do we elevate that value? How do we produce alpha and then have that realized in the form of a token? That's what makes the token itself valuable. That this good real estate, if you want to invest into it, the only way you get into it is through a token. And then that gets people to buy the token as opposed to any sort of alternative.
For sure. And we're also in a unique position where we have the credibility to educate, through our platform. Not only it's like, wow, it's a good investment, but we throw all that information, the investment thesis, why we like the market on there. There's really nothing we don't hide on a property page. So it gives people the ability to be like, that's interesting that they pick this market for this reason, Anyways, educating is a big part of our aspect as well. And anyways, we're building out something you'll see later this year that'll be nice on that front.
Well, I'm intrigued. Is there anything you can share about that?
I'll simply say it's going to emphasize even more of that educational aspect, make it more of like a portal in a sense that, people can get accreditations and basically just like a miniature kind of run through on, real estate investing, at a high level, at an institutional level. So.
Okay. Well, that's great. And I think that sort of transparency is really needed, whether it's retail investors or higher grade investors, to offer a standardized expectation for what a property should show about itself, what details you can derive from that, and then what decisions you can make. Knowing, here's this metric, and I use that for my investment strategy, and now I can put money into this confidently because they've included that information. And, as you scale up to institutions as well, not only are they looking at that information, but they have to report that back, right? They have certain requirements when it comes to reporting to their stakeholders. If it's a family office and you have your managers there, what's going on with all this wealth that we're managing, or even financial institutions. Just that accessibility of information allows them to make decisions that they couldn't otherwise, because they know that they can maintain compliance throughout the investment process.
Totally. It's good for the experienced and institutional level, but also retail level as well, kind of the full spectrum.
Yeah, and if you have the confidence of the institutions, you can certainly start to win over those retail investors who don't feel as if the risk is being offloaded to them, which is something that we saw, in 2008, where the financial institutions are selling off all of their financial instruments that were prepared to collapse, but weren't being marked that way. And so you have retail investors coming in and buying this up, it's becoming their investment strategy, or maybe there's family offices, and all that risk is being offloaded to them. And so the alternative is saying, well, actually, institutions want in on this too, and we're democratizing that same investment to the retail investors. So it doesn't have to be retail exclusive, because people always get the question, well, why doesn't anyone else want to invest? Right? But if you can say it's that same quality of deal, and we're just giving you an opportunity alongside the bank and this big investor, and you get in too, because they think it's going to be a great return. And for that smaller investor, they say, "Oh, this is great. I'm actually grateful now that I get to participate into this," as opposed to being weary about the investment.
100%. And when you asked the question, go ahead. I was just going to round up with you asked the question to most people, like, hey, do you have any goals of owning income properties at some point or even today? 95% say yes. But, there's that, again, barrier to, I just don't have the time or the money right now. Okay. So, again, model solves that barrier.
I was going to say that this is really pertinent throughout like Web3, the number of tokens that come out, and they're released in a way that retail investors can get into them, and they're promised big returns, and the institutions aren't going anywhere near it. And now more in Web3 than ever, people are looking for that institutional confirmation that maybe a big asset manager or just a big investor in general has moved into the space and is putting capital in something to confirm that it's legitimate, because we're starting to appreciate some of that due diligence that the large players can do with all of their analysts and tools available to them, and say, well, they wouldn't put money into this coin if it wasn't worth something. I think Bitcoin is the best example, where a lot of money, yeah, right, moved into Bitcoin, and now you have the everyday person saying, okay, I will invest into Bitcoin. But all the altcoins, or tokenized this, that maybe it's an asset that is just not appealing at all, people say, well, I'm going to wait until there's more real smart money going into that before I start to engage. And so I think, just going back to the quality of the transparency, and even mentioning the co-founder's Goldman experience, I mean, I think that's critical, because when you tokenize something, it just comes back to first real estate principles. Like, is this a good investment? And a lot of platforms neglect that, or they're betting on investors not having that sort of sophistication when they solicit these investments. And I've pushed back on that quite a bit. There's some examples out there that we shall not name that will tokenize anything and just hope that retail or non-US investors don't understand the markets that they're buying into and say, oh, well, it's tokenized. This is really cool. I'm going to get into it.
Because it's a buzzword, especially in like 2021. And I've done a lot of research on just like blockchain real estate companies in general. And you saw so many pop up, and not many of them are still around because of the buzzword. But again, and if you go to our website, you're not going to see blockchain, crypto, tokens like up there front center, because the focus is real estate. The focus is the asset. So when you think about also just a traditional real estate investor and like a crypto investor, they are complete opposite sides of the spectrum. So for us, just the leverage of blockchain as like a back end efficiency solution for all this, kind of the guide rails in a sense, is where we emphasize it, and not like a buzzword up front, just like attract people. Like that's not our model, and so far it's working. And yeah.
So now I'm curious about your model. So Mogul goes out and acquires properties and adds them to your fund that you have. You're not working with other sponsors to list their properties. Is that right?
Correct. We're the ones going out there doing the research, the analysis, acquiring, and then bringing them on platform.
Do you think there's advantages to that, as opposed to maybe performing the same due diligence on someone else's property? Is it perhaps that you become dependent on them to execute?
Not dependent on the execution, but I mean, we do work with inventories partners in a sense of feeding us data. We'll kind
Okay.
of create our buy boxes. We'll say, hey, we like these markets. And then, we get 1,000 plus of those a month, and then can filter through and move on the ones we like. So yeah, traditional sense inventory partners, but we're still doing all the analysis. So yes and no, both sides of the coin.
What what led you guys to focus on the rental market? Because you could get into commercial real estate or new developments. What's the strength of like a single family rental?
Single family rental's been our focus for a couple of reasons. One, that's where Alex and Joey's expertise was at Goldman. Goldman was buying up single families, creating a big portfolio. They ended up deploying over, $10 billion, the asset class, and Alex and Joey were part of that. So again, a lot of experience there. Single family rentals, again, versatility on long, short, medium. Um, on average, a single family home is going to rent out 20% more each month than an apartment. Just warrants more, for obvious reasons. It's a home. I'm not saying an apartment isn't, but like you have the land, it's yourself, it's there, it's all you. You're not sharing wall to wall with someone necessarily. So that's another. And I will say this though, commercial, industrial on a fractional basis is certainly on the roadmap. It's a few years down the road, but for us, we want to prove out the single family rental model first. And it's also just a easier way to scale at the level we are now. If we were to go blow out commercial, we'd have to raise significantly more capital
Right, right.
to do that. And again, it kind of bucks a little bit of the concentration risk that we talked about because you're buying one or two big assets, as opposed to 15 to 20, so diversification in that sense as well.
Right, right. Unless you were working with other sponsors, then you wouldn't have to necessarily raise on your own in order to acquire those, which is interesting. Do you have any plans for like co-listing deals? Has that, because I've started to see that model emerge where marketplaces don't want to live on an island, and so they're sort of co-listing deals and trying to share investors and bridge blockchains. Is that, what do you think about that?
A bit, yeah. And it kind of speaks to this B2B approach that we've been having. Is there are other platforms out there, but maybe they've been in business a few years, and their IRR is in the 4-5% range, and maybe with some of those assets, maybe in the 0 to 1, and people complaining. So bringing definitely a different value set to their users and investors with, our inventory. So kind of commingling, like you said there, as us being an inventory partner for them. Yeah, we recently partnered with an international kind of real estate platform company in January, and they wanted exposure to the U.S. market. Their investors, wanted that, and we've been a great partner for them, and vice versa. So, yeah, certainly to answer your question, definitely. Why not? Many streams equal wherever. Instead of fight them, join them. That's a whole lot of that.
I'm glad that you mentioned this international company, because I was thinking in my head what the opportunity could be for international investors. You've got the whole world at your fingertips. Does the way that you file the exemptions enable that? And okay, so yes, and then
Yeah.
like what's the plan there? How do you think you can attract more investors to the U.S. market? And are there certain regions you're prioritizing? Or, I mean, how do you turn this into a global operation?
Right. Yeah. So the international demand, or at least strategy, has been there from an early stage. The U.S. market is strong. The U.S. market is ginormous. There's so many different markets of opportunity to tap into. So, from a strategy perspective, we've looked at more pro blockchain companies. This is more lately. Oh, sorry, countries. So El Salvador, Bitcoin's a legal tender there. Turkey, triple digit inflation. So they're, pro Bitcoin. So yeah, we started to reach out to some of these pro, blockchain Bitcoin countries because it's an easy kind of concept of like, oh, blockchain and real estate. We also accept stablecoin investment. So if you're familiar with stablecoins, USDC, Tether, they are a cryptocurrency, but they're pegged to the US dollar. So they're not fluctuating price. And that's a really easy sell for an international investor because it's simply just, here's an address. Great. Send it, done. As opposed to dealing with bank cross-border stuff, the fees of wire transfers, yada, yada, yada. So that's been an interesting avenue we started to explore. But yeah, I mean, for the last 100 years or so, the rest of the world's been kind of interested in investing in the US, and it's kind of innovated, entrepreneurial, hardworking nature. So definitely trickles to the US real estate side of things. But caveat there is there's definitely some geopolitical tension out there, and people being concerned of, oh, what if taxes change for international investors, owning a piece of US real estate. Yeah, so I think it's just weathering the storm and coming out on the other side, and we're all friends again. Knock on wood.
The cross-border settlement is a great point. I mean, traditionally, to invest in U.S. real estate, the exemptions are there. Paperwork's easy, and you can solicit to investors, but then actually handling the money, collecting it and sending it back is where there's all these intermediaries and slow settlement times where it could take a week to get those dividend payouts. And as you're building a model where there's supposed to be maybe more transactions or more frequent payments, if you're still on outdated payment rails, everything's considerably behind schedule, really. And then you rack up all these fees, which is why you'd send out money in one instance instead of frequently, because you have fees that accumulate in aggregate. It wouldn't make sense. You'd rather wait for, once a year in order to get paid out. But now you see this model of a global investment economy that emerges, and even for them, it's a good way to diversify, because you could invest in, or they could invest in their local economy. It could be an emerging market, rapidly developing, and then they're borrowing more stable real estate, U.S. real estate, that's just for the cash flow, and mix and match their investment strategies that way. And if something geopolitical arises, maybe they're in Eastern Europe, right? That's a tricky place to be right now. Juxtapose that with the U.S., although we have our fair share of political quarrels right now, they're not correlated generally. And that's the strength of diversification, is picking asset classes that aren't correlated so that even through the recession, you stand strong.
Totally. 100%. And I use that same exact argument to, people in real estate and real estate investors here in the States that I talk to, of maybe they have their own developments, they have a property or two. And I'm like, I'm not saying sell all that, move to Mogul. I'm saying Mogul can be a diversification strategy within your diversification strategy.
Right.
Kind of working. Yes, I'm sure you're really good at what you do, but I can say Alex and Joe are too. So again, it's that diversification across human error, hubris. Like there's many ways you can kind of explain it.
Yeah, absolutely. So to change tracks a little bit, are you looking at anything on the artificial intelligence, in terms of tools or integrations?
No, we aren't. I'm sure at some point, we'll probably replicate Joey's brain into some, AI solution that's going to help scale in a sense. But no, not for now. I mean, we saw a lot of companies, including one of our competitors, just like slap AI into their URL and on their website, and they're not really using it. Again, buzzword. Sorry, we're not like trying to be trendy. We're just trying to be a very solid staple. We're not here for a short while. We do have long-term aspirations here. So again, that foundation of just focus on the real estate.
Right.
Is it a good investment? So.
Well, that said, Are there any AI tools you guys are excited about or could see adding value to your platform or the industry at large?
Uh, I mean, this is so basic, but an AI kind of chat box or agent on our website that is not just a three prompt agent that is out now, but like an agent that we can educate again, maybe on Joey's brain and
Right,
kind of
right.
feeding that into it and having that be kind of an automated, answer questions. And, on the sales outreach too, there's been a lot of these kind of AI sales agents. Um, we've kind of explored those as well, just from like a scaling perspective. I just listened to the uh, Tesla all hands meeting last night, and he talked about robotics. So of course I'm thinking about their animus robots and the next 10 years. You know, we're going to see a lot of that, like more boots on the ground. Property management. Doing the little your gardener is going to be a robot in 10 plus years. You know, um, yeah. So, anyways, that's what I see happening. But yeah,
Well, still an opportunity there. A lot of chatbots are a one trick pony where you can ask the most basic questions, and at that point, I'd rather just search through the documents myself. Because oftentimes, if you don't phrase a question right, it gives a junk answer back where it's like, I didn't quite understand that. Maybe you meant this. And it's like, no, I didn't mean that. But for those investors who want to do due diligence or even different languages, right? Just being able to localize the information for people who are coming from a different background and to understand this market and contextualize that information, super powerful. And I think that's where a lot of the industry is interested, the natural language processing. So you can start to communicate with the properties a little bit. Like, why are you going to appreciate this amount over the next year? Well, here's the trend in the Austin area, and we're not worried about oversaturation because of this. We're also adding alpha in this way to help the property or the community, and that sort of transparency is really what it is, because you're understanding the business plan and the market at in more detail than any time before. That sort of transparency, I think, is what real estate has needed for so long. You usually, of course, you don't have access to that information, but then you only hear what the property owner wants you to hear. They have a deal that they need to solicit to you, and they're going to put the skeletons, keep them in the closet. And that, I mean, it leads to a lot of fraud and deals that don't meet expectations. And next thing you know, you could have a class action suit against you. So just keeping cards on the table and helping people understand the risks and the rewards of an investment deal, there's no better way to get them to put their money into something, to really understand, I know exactly what I'm getting myself into, and it matches my thesis as an investor. Let's move forward with it.
exactly. No stone left unturned.
Absolutely. Absolutely. So you've mentioned this secondary marketplace. What else do you guys have on the roadmap for 2025?
We have been working on something in closed beta that we're really excited about. It's funny, I'm not sure how much of this I could share, but I'll do my best. So with the rise of certain community platforms, if you're familiar with School, Alex Hermosi, it's basically like a community platform, and obviously social media. But we've created this concept around investment clubs. So not only would we be a platform to like, ooh, properties, I'll invest in these and then log out and I'm getting my recurring, but more so a place for people to log in, stay, engage a bit, and join and participate in kind of a community-based investing. So it should launch here in Q2 to the public, but it's this concept around investment clubs and creating like a bespoke investment club around a certain individual or already existing community. Um, I can say this because this was in Forbes last year, but we launched kind of our initial one with the Players Company. It's basically a conglomerate of 500 or so professional athletes that educate themselves on personal finance and invest together. It was founded by a Stanford finance guy and Richard Sherman, who was like a Seattle Seahawks cornerback, and they wanted a better real estate avenue and real estate arm, and we partnered with them and created their own kind of Mogul Club, their own investment club. So members join, they invest. There's a revenue share, so kind of like a bonus program. So that kind of keeps things fun. We don't want to again just be like log in, click, done, leave. So that's something we're excited about, and you should see it come out here in Q2.
Well, it's a great idea. The more reasons people can stay on your platform or find value and turn it into a household name, where it's like, well, if you want to learn this, go sign, into Mogul. I do that with like Coinbase all the time. I don't really use Coinbase, but they keep me coming back to their app because I want to check on the price of stuff, and I read news there, and you get analysts reports, and so it's like I keep going back. That's where I get my information from, and it'd be the same way. I want to talk to people about XYZ. I want to see what's happening in the market. I'm going to go sign into Mogul, and it creates that stickiness, that brand awareness, and that, what would be the word? Confidence, relationship, trust, something along the lines.
The stickiness is the big one.
Right.
Because again, it's if you can be part of something with others, we're social creatures at the end of the day, even if it is online. So if you can kind of participate in something together, get rewarded. And then, there's so many angles that these clubs can go, but true to the Mogul Club name, we're gonna launch that, and that's what's next on the horizon.
And that's why club is in the name, right? So you're not just striving to be an investment platform, but to be an investment club.
Yeah, through this avenue. Yeah.
Okay, very cool. That's awesome. And of course, if so and so is investing in this deal, I think I might jump in. We're always keeping up with the Joneses. Yeah, that's the term. And so like, oh, they're getting in this. I don't want to miss out.
Totally. And the revenue share, for example, just hypothetically, let's just say you have a group of people, you have a group of investors that, real estate inclined, blockchain native, whatever it may be. You create that club, around you, Matthew. The revenue share also, can be participated with the chief of the club. So like you're incentivized to get people in, invest, and you're not sharing your investment with anyone. You still like your investment is your investment. It's your profile, but you're kind of pooling it into the club. And, as the club invested dollars, go like you as a chief mogul make a certain percentage, and some that can be shared back to the members of the club. So it's a cool kind of flywheel, keeps incentivizations kind of aligned. We're super excited about it.
Awesome. Well, as we wrap up here, we've got a glimpse at your roadmap. My last question on that is, do you see any other areas where you might be using blockchain technology or any DeFi strategies in store?
I don't think so. Yeah, I don't think so. I will say this, like zooming out, not just on Mogul, we have, for the first time in US history, more regulatory clarity around blockchain.
Right.
First blockchain friendly, president in history. And I think you'll see a little bit more of a push in that space. Like, yes, crypto projects, great, sure. But I think you're going to see now like the kind of real world assets coming on chain a little bit more. BlackRock, talking about like tokenizing bonds. I think you're going to see a lot more tokenization of real estate. So I think zooming out, the environment is ripe, for more adoption, more innovation, and in turn, more acceptance. So more household name, and that's good for everyone. But Yeah, especially us. So we're excited.
Awesome. Awesome. Well, the time's certainly now. So if people want to get started, how can they learn more?
www.mogul.club. That's the website. From there, you can create a profile, can browse our available properties. And we do a weekly newsletter. Alex, our CEO, is a brilliant writer. We get such good feedback on that because, again, it's educational. It's kind of a update on what's happening in the world, what's happening in real estate, and then, like, lastly, what's happening with Mogul. So, yeah, once you kind of sign up, you're kind of plugged in there. So that's how you hear about it. But also, me personally, my email, grayson@mogul.club. Happy to reach out, chat, answer any questions anyone may have if they're interested in kind of building out a diversified real estate portfolio that is performing, let's just say, significantly better than the average.
And I will have your LinkedIn in the show notes and that link to your site so that people can check that out. What type of investors can join? Is it just accredited or?
Yeah, no, so it's funny we didn't even talk about that in the beginning. So anyone over the age of 18 with a minimum of $250,
Oh,
that being
wow.
our minimum investment size, can join and participate in the platform and
Nice.
owning pieces of the property. So we have investors that come in at the minimum, 250. We have people that come in at six figures. It totally depends. It's kind of up to them. But yeah, either way, there's really no other vehicle right now like ours that allows for such an efficient as well as profitable kind of option for people to, hey, I want to go build a diversified cash flowing, monster of a portfolio. And again, monthly rent, appreciation, everything we buy is off market. So there's kind of a discount there to, we're negotiating down. So there's a day one appreciation kind of baked in there, and then tax benefits. So it's like you're a traditional owner, again, just without the headaches. So, and the barrier to enter, my gosh.
Awesome. Awesome. Well, that's all super, very compelling. Grayson, it's been a great conversation just talking about fractional ownership and the benefits of that, especially at an international level and what this means for people looking to get into real estate. So thanks for joining us today and sharing your perspective and letting people learn about Mogul. You guys certainly have a lot of traction and haven't joined the come and go of platforms, and it doesn't seem like you're going anywhere but up from here.
It's absolutely my pleasure. Yeah, I appreciate the words and the time to share what we're doing.
Awesome. Well, wishing you a good rest of your day, sir, and thank you to everyone who's tuned in today.
Likewise, Matthew.